Good morning. Welcome to 3 Minutes on Markets and Money. Well, here we go, getting ready to wrap up our week. Already it's Thursday, and markets have really been trading fairly poorly this week. Markets yesterday coming down, testing the 20-day moving average. Now, this is a normal thing that we've seen here over the past several months, is that this continued kind of grind higher consists of these interim tests of the 20-day moving average. That's really been where the markets run on a regular basis here. Markets should try to bounce off of that today, make a move back here towards recent highs, maybe even set potentially new highs. The risk, of course, ultimately is a break below that 20-day moving average that leads to a test of the 50-day moving average. Now, we're not expecting that until next week when we get into options expiration week. Now, that would align with normally each one of these previous tests of the 50-day moving average going back several months has been on options expiration week. So as options traders roll those options into the next trading session, that's been leading to this sell-off in stocks. Now, again, is that going to be the pattern that remains this month? We'll see. The markets still continue to grind higher here. Now, the interesting thing is we've now triggered a money flow sell signal yesterday because of this weakness in the markets. Now, with money flows very positive, this hasn't meant a whole lot lately. It just means that prices remain contained within these kind of stair-step movements of the markets. Going back all the way here to November, we can make this move higher, kind of consolidate, retest 50-day moving average, rally to a new high, consolidate, test the 50-day moving average, continuing that kind of stair-step advance higher looks where we tend to be right now. But we are to the point, we're getting very close here. Money flow sell signal, MACD sell signal getting ready to trigger. That could suggest here coming up again next week a retest of this 50-day moving average at least. And again, the bigger risk ultimately is that we might get a bigger correction at some point to potentially even start to look at retesting the 200-day moving average. We've gone a very long time without that type of a correction. More and more of the major investment banks out. Morgan Stanley, Bank of America, Credit Suisse, Goldman Sachs, all starting to suggest this idea of a 10% correction. Now, is that going to happen? Who knows? We have a market where breadth remains extremely narrow here, and you're getting this kind of deterioration in volume and support, and breadth continues to weaken across the board. Fewer stocks actually leading this charge. The number of stocks above the 200-day moving average, the number of stocks above the 50-day moving average continue to weaken here, suggesting there is a higher level of risk of a correction in the near term. So again, how to manage this in your portfolio, of course, look to take some profits here. Stocks that have done exceptionally well, just sell some of them. Doesn't mean sell everything. Put stops below positions in your portfolio that have done extremely well. Don't give up a vast majority of those gains. Look for areas of the market that have not done well relative to the market itself. So in your portfolio, stocks that haven't performed well during this market probably won't perform well during a decline. So maybe look to remove those entirely from your portfolio. Again, just a bit of proper maintenance of your portfolio will help you kind of survive any potential downturn that we have. Not looking for a major crash at this point, but a healthy correction, which would be a buying opportunity, would be beneficial. And again, taking some actions here to raise some cash will also give you some buying opportunities when we do have some type of correction in the markets. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you back here tomorrow.